Hey everybody, hope everyone's doing well and had a good day. This is the Emini review for Friday, July 5th, 2024. And before I get into it, I apologize for the audio in my voice today. I'm battling a cold and I lost my voice earlier today, and this is the only way I can really talk. But we're going to push through it. Today was Friday, so we'll look at the weekly chart first. And you can see what happened. The bulls got a bull trend bar closing on its high, closing above all the bars to the left. We had a tight trading range here and then an outside bar. There is a risk for the bulls that this is 1, 2, 3 pushes up, and outside bars are typically trading range bars. They're expanding triangles on lower time frame charts. So as strong as this bar looks, it may not be ideal to be buying or long above this bar. There might be sellers above. And coming into the day, by the way, I usually use the extended hours chart, but for some reason I'm getting this giant bear bar. Actually, let me see. I don't know why that is. It's really strange. So I usually look at the extended hours, but we're going to look at the day only session for the daily chart today. The market's in a tight trading range, but all the bars are above the moving average. And so what we have is a bull trend. We have higher lows and higher highs. Consecutive bull trend bars, probably too much momentum. The bears aren't going to just sell blindly because we're at the top of a trading range. They will prefer to sell a second reversal. And it always amazes me. I've heard Al say it all the time, that channels can go a lot further than you think is possible. And just look at this bull channel. It's pretty amazing. Let's look at the Globex coming into the day. Here's the close. Actually, we'll look at the 15-minute chart. Here's the close of the 4th, which wasn't a full day. I guess that's actually the morning session. The point is the market's in a trading range, and that's breakout mode. So the market's sideways all through here. And then pre-market, we had this big bull breakout and a huge tail above. But remember that distance is more important than the close of the bar. So this breakout was really significant. It went far above all the bars to the left. The odds were there were buyers below the bar, and this would get some sort of second leg reaction. You had bears selling the top of the range, and they got trapped all the way up here. And that's disappointing for them. And you had bulls who didn't buy at the top of the trading range. And then obviously we know it went more sideways, but ultimately got the bull breakout, the bull trend. Like I just showed, the market's been in a tight bull channel for the past couple of days. So that's what we have coming into the day today. Here's bar 1. The market is always in long. Just look at the chart to the left. When's the last time we had a close below the moving average. It's all the way somewhere down here. This is a lot of bars above the moving average. So that obviously tells you the market is in a bull regime and you should be looking to buy, and it's always in long. Whenever it's always in long and you're swing trading, Al says it's important to just get into the market. As soon as you decide it's always in long, you can just buy for any reason. Use the correct stop, which is probably below this major high or low. Bull breakout to a new high, stop below here. Bar 1, we have a bull reversal bar closing on its high, but tight trading range for the past 5 bars from yesterday. Now, because the market's in a bull trend, I'm expecting reversals to be minor. So we are at the top of the channel, or near the top of the channel, and so that will increase the probability that bulls will take profits here, and will go more sideways to down, and bulls will look to buy below bars. In channels like this, bulls buy below bars and take profits above bars. But bar 1 closing on its high, probably going a little higher. Not an ideal short. Limit order bears probably not eager to sell above bar 1. Probably sellers above 42 though. Bar 2, we rallied above 42, this trading range bar. This is a small trading range on a smaller time frame. We're getting a bull breakout attempt, but the odds are we'll at least pull back first, if not reverse. But because of the regime, I'm expecting reversals to be minor. Probably buyers below bar 1. And then doji on bar 3. So we went sideways, bulls taking profits at new highs. What about selling bar 3? Well, it's always important to look at, when you're in a trend, look at the gaps. We have a couple of open gaps, and there's more gaps open all the way up. So if there's gaps, that means bears are getting trapped, and there's fuel in the market. The trapped traders are providing fuel to the upside. So I would not be looking to short for any reason here. If I were a bear, the first thing I'd want to see is a strong trend line break. Al talks about it all the time. Major trend reversals. You need a strong break of the trend line. Here's the trend line, the bottom red line. You need a trend line break, and then a retest of the trend's highs. And even still, at that point, there's a 40% chance of a major trend reversal, 60% chance the market goes sideways in a trading range. But you can see all the way up, there's very little selling pressure. Every bear bar gets bought, and there's no trend line breaks. So bar 3, maybe bears are selling up here for scalps, but the reality is this is a bull trend, and traders are buying for any reason and scaling in lower. But because bar 42 is a trading range bar, there's probably sellers above. We may test below it. And that's what happened on bar 4. Bar 4 is a little bit of a surprise, but look where it tested, straight down to the bottom of the trend line, and that is support. The market tested the trend line and then rallied into the close of the bar. So bar 4 is a disappointing bar for the bears. Strong enough it might have a second leg down, leg 1, pullback, maybe a deeper pullback, leg 2. But look at every bear trend bar. Like look at this bar here. Bar 79 on the second. Bad follow through and then immediate reversal. Every bear bar has bad follow through. So because we have a bear trend bar in a tight bull channel, that's enough reason for traders to buy. And then look at bar 5. It's a buy the close bar. The problem with 5 is that it's going straight back to the channel line, which is where bulls are taking profits. There's probably sellers above bar 4 for a second leg down. So the combined selling above bar 4 will probably lead to more sideways to down. But again, it's still always in long. This is minor. There's no major trend line break. So it's okay to still be long, stop below 40. Bull breakout, bar 6. So bar 5 is a breakout bar, broke out above 4 but closed below, and then 6 is a follow-through bar, closing above all the bars to the left. Because bar 4 was big enough of a surprise for a second leg, like I said, there's probably sellers above, and then you combine that with it's possibly 3 pushes up. 1, 2, 3. The reaction we're not expecting this to be the high of the day and to sell off all the way down. But because it is consecutive buy climaxes above this bear bar, there probably are more sellers. And this might just be a vacuum test of resistance. Remember, in a bull channel, bulls are taking profits at the channel line and above bars at swing highs, and they're buying below bars. So this is not an ideal place to buy or to be long, but still always in long, okay to be long, but stop below here. Bull breakout and follow through, 6. 6 is really the first breakout bar above all these bars and the channel line. Also keep in mind, there's about a 25% success rate of breakouts of channel lines, and it's parabolic. What we have is a parabolic wedge. Now we know the channel is tight. We know that it's a breakout on a higher time frame chart, so we know the reaction we're expecting is for it to be minor, but we could easily come back down below bar 5 before we find buyers or the moving average. They're about the same price. And then we have a bull breakout but disappointment on bar 7 above the channel line. 75% chance. Breakouts of channel lines reverse within 5 bars and then test the trend line. So that's the problem with being long here. And bears will sell that bad follow-through bar, betting that the bulls had consecutive buy climaxes. It's a bull breakout attempt of a channel line, but no follow-through and only a small breakout. And decent amount of overlap here. And then getting the bar 7 disappointing follow-through bar is enough for bears to sell because bulls are disappointed and they'll look to buy lower. And that's why we got that big bar on bar 8. But when you see bar 8, it's easy to see bar 8 as a strong enough bar for a second leg, but the danger is that it already is a second leg, and it might actually be a third leg. What we have here is an expanding triangle. And so we have maybe 2 or 3 pushes up, 3 legs down. The market's in breakout mode, and this expanding triangle is more likely a bull flag than a major trend reversal. And part of that is because where's the major trend line break? I just demonstrated that. You need to have some sign of strength by the bears, and this is not enough. This is a trading range in a bull trend, so that's a bull flag. So bar 8, like bar 4 and all these other bear bars, is more of a buy the close bar. 9, bull reversal bar. So here's the expanding triangle. Traders will buy above bar 9, betting it's an expanding triangle and maybe the opening swing of the day, decent reversal bar. Even though bar 8 is this big bear bar and it might get a small second leg, the second leg it might get is expected to be minor. I wasn't watching today. I don't know how this bar formed, but it's possible bar 8 sold off, pulled back, then bar 9 sold off, and then pulled back. So this might already be 2 legs down, but it already is 3 legs down. And this is a problem for the bears. Bears will exit above bar 9, and bulls, always in bulls if they got out for any reason, can buy again above bar 9. A bull bar closing above its midpoint, always in long. 10, bull trend bar breaking out of bar 9. There is a risk that bulls bought below bar 7. They got trapped on bar 8, and a retest of this price will lead to at least a pause. But the reality is that If bulls are taking profits up here and buying below bars, they probably weren't really buying heavily below bar 7. That's what contributed to the sell vacuum. No one was willing to buy up here. The market had to fall to find buyers. And where the buyers come in? Below here. Bulls buy below bars. Consecutive bull bars, 9 and 10. And like I said, we might pause at this breakout point, but for now, in this context, it's not looking very good for the bears. The bears still have to do more. It is a trading range open. There might be sellers above 7, but I do think we're going to get above 7. 11, another bull bar, 3 consecutive bull bars. It's a micro channel. It's not the strongest micro channel. Bar 9 is a small body, big tails, lots of overlap here. Also within this trading range. It's not ideal, but there's probably buyers below bar 11. It's a bad low 1, bad context, bad signal bar, 3 bar bull micro channel. In an overall bull trend. 12, an inside bar, went sideways. You can see we paused at that breakout point. But is this enough for bulls to panic out? Probably not. The opposite example, it's kind of like over here. It's not the greatest example, but let's say a bear sold above this bear bar, and then they get trapped. On the retest, here's the retest, and then you get bar 13. That's a bar you need to get out, even though it's a 3 bar micro channel. The context, bull trend, good bull signal bar, pull back to the moving average at a breakout point. This is much different than this. Bulls are not going to panic out below 12 because they got trapped on bar 7. So the expectation is a minor pullback, but then continuation. Outside up 13 might not be technical, but as long as the lows of 12 and 13 are the same, which they are, then 13 functions as an outside bar. I usually say outside bars. The thing with outside bars is it depends on context. When you get outside bars in trading ranges, Al says they're meaningless, and what he means by that is that we already know the market is sideways. Outside bars just mean there's a failed breakout to the downside, now a breakout attempt to the upside, which might fail. But again, just look at the chart, and you can see the market's clearly in a bull trend with open gaps. We have an expanding triangle on the open, and this is still a micro channel. There's probably buyers below bars. We're probably going to test above bar 7. We pulled back on bar 14, the first pullback since here. Not a very good buy signal bar on 14. It might be a bad high 1, high in a trading range. But the problem with that setup, I keep saying it, it's the moving average. All these bars, we've had one close below the moving average in, I don't know, how many bars is that? Maybe 100. So not ideal to be looking to sell. And if you are looking to sell, better to sell extremes, like the new high of the day. But I would not recommend that in this context. Because look how difficult it's been for limit order bears to make money all the way up. Al says you don't want to be the first bear to make money. You let someone else make money first. And it's really a sign of strength when stop order bears make money like they did here, below 7. But we know this is an expanding triangle in a bull trend. Really not ideal. Bull breakout 15. Above a bad signal bar, so the high of 14 becomes support if we come back and test there. We're testing the high close of 6, where bulls may have been trapped. We might find a minor pullback there as well. But this rally is strong enough that the first reversal attempt will probably not succeed. 16, we're getting that minor pullback. Disappointed bulls over here, taking profits. But as a bear, are you looking to sell 16? Probably not. You can call it a low 2, low 1 below 13, low 2 below 16, and it's nested, low 1 below 7, low 2 below 16. It's a double top. But again, bull trend. Most of the bars really completely above the moving average. So double tops are reversal patterns, but reversal patterns in trends are continuation patterns. 80% of them fail. So it's better to look to buy below 16, betting on the failed bear reversal. 17 fell below 16, and there were buyers below. A couple of bars sideways, tight trading range. The market's deciding, and the bears are hoping the expanding triangle continues and we get the bear reversal and then eventually the bear breakout. Maybe a vacuum test of the 60 EMA. But look at the selling pressure in this rally. It's not good enough. Look at the bull bars in here. Consecutive bull bars closing on their highs. And again, the regime. The bulls have the advantage here. 17's a weak high one, but because of the context, in a strong bull trend, traders can buy for any reason. 18, it's a bear trend bar, but because of the context, it's a really small bar with overlapping bars. It's more of a trading range bar. And there's probably buyers below 18 for the reason I just said, double top, but in a strong bull trend, probably a failed reversal attempt. But the bears hoping that the expanding triangle holds. And then 19 is not the bar the bears wanted to see. And when you get 19, imagine if you sold below 18 as a bear, hoping for a big breakout, and you get 19. 19 might be enough for you to bail out of the trade. And that's what happened on 20. Bull breakout on 20, there's a tick gap, sign of urgency. And this is all really a tight channel. So you should only be looking to buy. Even though there's this resistance here, and it is true, the bulls might be looking to take profits around here, but it's still always in long and okay to hold long. And when you think about the day structure, the bears may be hoping for a bar 18 reversal, maybe a second reversal down, but the selling pressure in here hasn't been impressive. And the bears have to do more. And with the inertia of the bull trend, it's very possible we continue in this channel. Like I said earlier, channels can go a long way and last much longer than a trader could ever imagine. 21, more follow through, but it's the first breakout above all these bars. So it's bull breakout 20, follow through 21, but 21 is the breakout bar above all the bars to the left. We still need follow through on 21. But think about the opposite side. Selling below 21 is a bad trade. A bad stop order is a good limit order. It's probably buyers below 21. Inside bar 22, probably buyers below. It's a weak sell setup in a bull trend. And we fell below 20 and 21 and found buyers below. In general, for a micro channel like this, you don't want to see the pullback fall below the third bar, as in 1, 2, 3. Falling below the first two bars here, that's fine, but it really damages the micro channel when you fall below the third one. So this is fine. Bulls micro channel, expect a second leg up. The bulls buy support. We know that we had a bull breakout on 20, the high of 19 is support. We didn't quite get there, so there's still an open gap. And then you consider the bar 18 open, maybe the bar 7 open. If the bears can get a close below these opens, then the line chart will close the gap. But for now, we have an open gap on the line chart. And that means there are trapped bears. And that means there's fuel to the upside. The bears will get squeezed out, and that will drive the market price higher. So high 1, 23, not ideal, not a very good signal bar, but still always in long, okay to be long. More sideways on 24. We did not trigger, so 24 is an inside bar. It's a tight trading range, but obviously unlikely to be the start of a major reversal, probably buyers below. 25 a bull trend bar, but maybe a minor trading range here. There might be sellers above 21, but it's minor. So that means there's an increased risk of a bull breakout and follow through above this. This is a bull flag. Bull breakout 26, but a small bar. But think about selling below 26. Not a very good trade. 27 is a shaved bull bar. Nobody was interested in selling below 26 and the market rallied. Look at the rally from bar 9. This is a tight bull channel. So even though it's now 3 pushes up, it is possible we have sellers above 27. Maybe 27 is a vacuum test of some resistance, like the channel line or some measured move. But this is effectively a parabolic wedge, which means if you can imagine the 15-minute chart or the 30-minute chart, this rally from bar 9 is all just a simple leg and a simple breakout on a higher time frame chart. And what that means is we might be in the late stage of the breakout, 1, 2, 3 buy climaxes. That might lead to some profit taking and a minor reversal, but that's the expectation after a parabolic wedge, is a minor reversal. Bull breakout and follow through, 27, 28, but testing that channel line, there might be profit taking here. It's really aggressive to just sell here. I would not advise doing that in a strong bull trend, even though it's 3 legs up. I would not be fading. The expectation is a minor reversal, but there's too much risk of an upside breakout. Disappointing bar for the bulls, trying to break out of the channel line on 29, outside bear bar. Might be enough to disappoint the bulls and go more sideways, but there's probably buyers below. But rather than buy directly below 29, bulls might wait to buy the breakout point, like the bar 21 high. Maybe. Or maybe the weak signal bar 24 high. Inside bar 30, but this is not an ideal place to be long, even though it's always in long, and it's okay to be long. Probably a stop. The closest stop is probably below 23, if not maybe 19. But now we have an IOI pattern that's breakout mode, and we're expecting, this is basically a parabolic wedge, we're expecting a minor reversal, so we could easily get a sell vacuum to lower prices. It's still okay to be long, it's always in long, but bulls might exit and look to buy lower. 31 bear trend bar, closing on its low, might go a little lower, maybe test the breakout point. We're expecting maybe 2 legs sideways to down, maybe 8 to 10 bars, maybe a test of the moving average. That's the expectation after the parabolic wedge. But remember, this is a breakout on a higher time frame chart, so any pullback is expected to be minor and then lead to a symmetrical second leg, similar in size to this leg. We fell a little lower on 32. 32 is a bad buy setup. It's a micro channel since bar 29. There's probably sellers above 31 for a scalp and a second leg down. 33 bull breakout bar, testing the top of this trading range. 33 might be a buy vacuum of resistance. Bulls who bought over here might have been disappointed by this sell-off, but this is a high too. It wasn't the worst buy in the world above 32, but I think the expectation is still leg 1, pullback, leg 2 after 3 consecutive buy climaxes. Disappointment, bar 34, probably sellers above, probably going a little lower. But 33 was strong enough for a second leg, and that's what we got on 35. But probably sellers above 34, there's your second leg, probably fall on 36. We fell below 35 on 36, but found buyers. We've had, this looks like 2 legs. It is sideways, but leg 1, pullback, and then a sideways second leg. This might be all the bears get. This is a really strong bull trend, and there's no reason to be looking to sell. 37, a little more to the downside, testing the bad signal bar, 32, but that, I said there were probably sellers above this bar. What I didn't mention is if this is a range, this is high in the range, this is low in the range, so there might be sellers above 32, but they may not come in until up here. But 32 is a bad stop order buy signal bar, and so we expect resistance above it, and then we get this strong bull breakout. So then the resistance above 32 becomes support. So when we come back and test it on 37, we bounce. And then we bounce on 38. This is possibly 2 legs down and the second leg subdivided into 3 pushes down, a test of the moving average. This is about, 10 bars. The expectation for the correction after the parabolic wedge, probably buyers above 39 or 38, even though the signal bar isn't great. The context is pretty good. It's a high 2 in a bull trend. Outside down 39, but remember about outside bars, they are trading range bars, and we're testing low in a bull flag. The bears really need a big bar, 40, to convince traders that this is a serious threat. But for now, when the bears need one more bar, the bulls will buy the close of a bar like 39. 2 legs down in a strong bull trend, testing support. Disappointment bar on 40. So bears who are short might give up after seeing the bull bar on bar 40. Testing the breakout point, the bar 21 high. We fell maybe a tick below it. Now we have a high 2 and a bull trend at the moving average. Decent buy setup above bar 40, and it's better than 38 because 38 was a first reversal attempt. This was a micro channel. Then we got that breakout, basically like a breakout pullback, and then a second reversal above 40. 40 is still a doji. It's not the greatest signal bar. Some bulls will wait to buy above a bull bar like 25, a bull bar closing above its midpoint at least, or near its high. But some traders will buy above 40. And then we get bar 41, which is that bar like 25 that more traders will buy above. And 41 is a problem for bears. And this looks like a minor reversal. 2 legs to the moving average in a strong bull trend, testing a breakout point. We'll probably rally further. 42, a pause bar. We tested there was no micro gap because the low of 42 tested the high of 40. Would have been better for the bulls if these bars didn't overlap. But what about selling below 42? Most traders won't. And if anything, they'll wait to sell up here. But I keep saying it, I can't say it enough. Think about the moving average. This is a bull trend with most of the bars, basically all the bars above the moving average. It's really hard to come up with an argument for selling in a market like this. It's still always in long. We never went always in short today. II pattern, 43, breakout mode. Consecutive inside bars. So inside bars reduces the probability for breakouts. It's a contracting triangle on a smaller time frame. Probably buyers below, but I would not sell above in this context. Outside bar, 44. And we've gone outside now. And there were buyers below 43 at the moving average. And now we have a micro double bottom, 42, 44, after a bull breakout. Bears might give up and more bulls might buy. 45, an inside bar. IOI, this is barbed wire, really tight trading range, but completely above the moving average. It's really a sideways pullback. Bull trend, and then the pullback is more sideways than down. That's a sign of strength for the bulls. So still okay to be long, probably buyers below 45. 46, almost outside up, but it behaves as an outside bar. But it's a bull bar closing on its high. It's not climactic, probably going at least a little bit higher. 47, bull breakout bar. closing above all the bars to the left. That's good for the bulls, but they still want follow through. Minimum follow through, 48. There's a tick gap going into 48, and then there's an absence of a bear body. Probably buyers below 48 for a second leg up. And then we did not trigger below 48, and instead the micro channel continued. So it's a micro channel since 44 to currently 49. Strong enough breakout for a second leg. And the breakout is growing. This is why Al says when the market's breaking out, it's important to get long. And let's say you bought here, and maybe your stop's below 46, and you buy the close of 49, and your 1-to-1 is here. So you buy the close of 49, and then you get 50. And then all of a sudden, you can go for this measured move. So you got in here, but now you can go for an even bigger risk reward. And then the breakout grew even more. That's the importance of getting long during a breakout. And this context is good. This isn't very climactic. It's a tight channel. We had a couple legs to the moving average. We're getting a rally. Consecutive bull bars, 50, 51, probably going a little higher. Strong bull breakout. Any reversal attempt will likely be minor and be a bull flag and lead to a second leg up. Remember, there's a possible leg 1, leg 2 we're looking for today. Here's leg 1, and maybe this is the start of leg 2, and this is a target for the bulls. I'll draw that so we don't have this big thing in our way. I'll draw it up here. And the breakout point's good. Get rid of this. And then a little higher on 51. Still a micro channel, probably buyers below bars. Inside bar, 52, probably profit taking. Bulls, they're buying all the way up, but at some point they have to reduce their risk. Their stop is all the way below 46. If they're buying up here, this is their reward. This is their risk. So there might be some profit taking to take some of the risk off, but any pullback is likely to be minor. Outside bar, 53, but it's a failed bull breakout. And 51, small body, big tails, then an inside bar, an outside bar. The market's going more sideways, far above the moving average. Traders might prefer to buy lower, and I'm always looking at breakout points, like the bar 29 high. It's possible we pull back to this line before the buyers come back in, and then get a leg 1, maybe a couple of legs pull back, and then a second leg. 54, it's a disappointing bar for the bulls. Bulls will exit below 54 because we rallied and we're fairly far above the moving average, and now we have a bear bar closing on its low. It's very possible the market just vacuum tests the breakout point or the moving average. So bulls will exit below a bar like 54 and reassess, look to buy lower. And bears can sell for a scalp, but I do not recommend that trade. 55, the bears got follow through, so bear breakout, consecutive bear bars. And I would say one being big, 55, but it's really not that much bigger than the average bar range. And what's the problem with 54, 55? I've been saying it all day. It's the moving average. Both bars are completely above the moving average. There's no trend line break. It could easily be a sell vacuum test of support. This was a strong bull breakout. It had a lot of things going for it. It wasn't climactic. Uniform size bars, bars closing on their highs, little overlap, in a bull trend above the moving average. Micro gaps, like there's a lot of things going for it. So this could easily be, now the thing is, 54, 55 is enough of a surprise. We probably won't go straight back up. Even if this is a buy the close bar, it'll probably lead to a failed high 1 above 55 and then pull back deeper for a second leg down for the bears. But that second leg is similar to this second leg. You're expecting a second leg, but it's minor. It's a pullback in a bull trend, and traders will look to buy that second leg. So traders bought the close 55 on 56, but it's a bad high 1 above 56, and there were sellers into the close. That might be the start of the second leg down. We pretty much tested the moving average. If we do fall below 56, there's probably buyers below. We may get to this breakout point, but this is still minor. Still always in long. 57, bull trend bar, but triggered the high one, which wasn't great. We're expecting a second leg down. So not ideal to buy here, but still okay because it's always in long in a bull trend. And then a follow-through bar, 58. But look where 58 is testing. You had bulls buying below 53, trapped on 54, 55. We're testing it on 57, 58. That was enough of a surprise. Remember I said we're expecting a second leg down, and that's because of the trapped bulls up here. You also have bears who didn't sell because this is a strong bull trend. So maybe bulls will exit on limit orders at the low of 53. Bears will enter short for a second leg, but that second leg is really minor. Outside down 59, but expecting it to be minor, probably buyers below. They may not come in until below 56 or the moving average or the breakout point, but I do suspect the downside is limited, and this is a bull flag. 60, it's a bear reversal bar, but it's a doji, possibly a nested second leg, leg 1, leg 2, and leg 1, pullback, leg 2 on 60. Probably buyers below. 61, we fell below here, came close to the breakout point, but not quite, and then a bull bar closing on its high. A high 2 at the moving average in a bull trend with open gaps. Breakout point didn't close. Bears will exit above 61, and bulls will buy. It's a good signal bar. Bad entry bar, 62, but it's a bad low 1. Really bad context. Probably buyers below. And then 63. Now we have a second reversal. So this was a 3-bar micro channel. It's really similar to what happened over here. 4-bar micro channel. The first reversal up failed. We went outside down, reversed up, and that succeeded. And then here, 3-bar micro channel. First reversal up failed. Now a second one above 63. That's an even better buy. And everybody bought on 64. 64 is a really good entry bar, bull trend bar. It's not climactic. Really small tails, probably going higher. Some profit taking, possible double top, but bad context. Remember double tops, any reversal pattern in a bull trend is a minor reversal. So traders will buy below 65, betting that the reversal will fail. And again, just look at the moving average. We've had like 1, maybe 2 bars close below the moving average all day. It's a very strong bull trend. 66 outside up. This might have been enough. Well, the bears are hoping that this was enough to make the market more neutral, but the reality is until this trading range grows to 20 bars, there's still an increased chance that we get the bull breakout. There's been no trendline break, and it's still always in long, so not ideal to be short or looking to short. Better to be long or looking to buy. 67, possible breakout attempt of a triangle. Traders will draw it different ways, maybe here, maybe here. But this is a bull flag, and it's possible we get a bull breakout and go for a measured move up to here. Sideways on 68. It's disappointing for the bulls. It's possible that we're high in a trading range, but it's not enough for the bears to sell. Some bears will argue it's a low 3, low 1 below 62, low 2, 65, low 3 here, 68, but tight enough up that this is a breakout on a higher time frame, and it should get a minor reversal and then a second leg up. And again, the overall context is not good to be looking to sell here. You can argue it's a wedge double top, but really not the place to be looking for that. 69, II pattern, so breakout mode. It's possible we get maybe a vacuum test to the moving average, a pullback, but I do suspect the downside is limited, and there's still an increased chance of an upside breakout. 70 fell below 69, but failed to break out. Buyers below 66, and this might be the pullback that leads to a second leg up. Bull bar closing on its high, 71. That might be enough for bears to give up. This is not enough selling pressure. This is a good bull bar. We could easily rally for some kind of measured move. 72, a really bad entry bar for the bears, but 72 is still a bad sell setup. Again, you can argue it's like maybe a low 2, low 3, double top, but the context is really bad. So as good of a signal bar as it looks, there's probably more buyers below 72. And then bears, if bears are selling below 72, they're taking a chance. It's a low probability trade and they know it, and they're giving the market maybe 20, 30 seconds to sell off straight through the moving average and just plunge down. And if it starts to hesitate or reverse, they'll just give up on the trade, and that's what happened on 73. So there might be buyers above 73, a double bottom at the moving average and a bull trend. And we rallied on 74, testing the high, attempting to break out of the high. It's common to see a profit-taking sell-off in the final hour in a bull trend, so I'm less eager to be looking to buy, especially at the high of the bull trend at this time of the day. I think there's an increased chance we get a profit-taking sell-off. But there's nothing to sell for now. Not a good sell below 74, probably buyers below. 75 breaking out to the upside. It was a bull breakout 74, just barely closed above, and then let's just do this. One tick breakout and then follow through 75. That's good for the bulls. Might go a little higher. But again, just concerned that there might be profit taking around this time of the day. Inside bar 76, that might be enough for bulls to exit. It immediately pulled back to test the breakout point, the high of 53. The bulls are hoping it's a bull breakout pullback, and then we rally for a second leg. The bears are hoping it's maybe some kind of consecutive sell climaxes, failed breakout of this breakout point, enough sideways to convert the market into a trading range. But they still don't have closes below the moving average, so that's a problem. Outside up, 77. There's a second leg for the bulls, leg 1, pullback, leg 2. Bulls might take profits on the close of 77. It's a bull channel, and they look to buy below bars and take profits above bars. And then a bigger outside bar, 78. Getting very late in the day, going more sideways. Not really worth doing anything here, and expecting more sideways to down. 79 bear breakout. Finally, a close below the moving average, but the first close below the moving average since bar 8, so odds are it'll get bought. And then sideways on 80. Just one more bar left in the day. Disappointing follow through for the bear breakout, probably buyers below. And then outside up, 81. For always in today, it was pretty simple. It was always in long the entire day. There was never a time that the bears made it always in short. And so a trader could be, here's the open of the day. You can buy for any reason, stop below major higher lows. So coming into the day, say you buy the close of 1, stop below 40 yesterday, you're good. And then maybe you get this bull breakout on 6, but no follow through. So not ideal to put your stop below 4. But if you do, you just buy again above 9. And then a bull breakout to a new high. You can be trailing your stop from 9 to 14 to 19 all the way up. This is a little too tight. This breakout did not go to a new high, so you would not put your stop below 32. That's what Al would call a skunk stop. And you can see what happened. The stop got run, and then it reversed up. The correct stop is at least maybe 27. Even that's really tight. You can see we got a very close test, maybe to the tick. The low, 56.06 and a quarter, and the same price. So if you had a stop below 27, you'd get lucky. That's a place traders are buying. Better to put it below 23 or 25, or even better yet, 23. Then this rally, you can put your stop below 40 or 44 or 46. And then here, you got this rally, your stop can get tightened to here. And that's about it for always in today. For stop orders, because it was always in long all day in a bull trend, traders can buy above any bull bar, closing above its high, or closing above its midpoint or near its high. So you can buy above 1 or 2. 6, not ideal, might be 3 pushes up. And we got that deeper pullback. You can buy above 9 or 10. 15, not ideal in an area where bulls got trapped. Better to buy a pullback. You can buy above 19, 20. Literally any bull bar closing above its midpoint is reasonable. The one stop order for the bears today, maybe 54, but that's not a trade I would take. That's not a trade I would recommend anybody takes. And for limit orders today, buyers below 1. It was likely we would fall below bar 1 after the rally up to 3, and likely we'd find buyers below because of the context. And then expanding triangle, buyers below this low, buyers below bar 8. I mentioned probably buyers below 7, but probably not directly below. Maybe a measured move down of the bar. And then all the way up, micro channel, bad low 1, buy below 13, bad low 2, buy below 16, or any of these trading range bars. And then another bad low 1, buy below 22. Another strong rally, but possibly 3 pushes up. Expect a more complex pullback, but still a minor reversal. So you can buy with a wide stop. Buyers below 32 over here. Bad low 143, buyers below. This rally, probably buyers below a bar, but this was getting far from the moving average. With the moving average kind of far, the breakout point, not ideal to buy up here. Most breakouts get pullbacks, so we got a breakout and then a pullback that bulls bought, and then a second leg. Strong enough down for a second leg, we got it, and bulls bought below this rally from 56 to 58. Bad low 162, they bought it. Bad low 165, they bought it. You can buy below any of these bars. Strong enough rally here for a second leg, but did not trigger below 76. And where do we go Monday? We had the strong rally on the weekly chart. I already said my concern with it, possibly 3 pushes up, tight trading range, but we know what's been happening, and the bears are going to have to do a lot more than what they've been doing to reverse this. So we'll probably start to go sideways fairly soon, but I'm not expecting any major reversal. And we were in a tight trading range here, but the bulls obviously getting a breakout. But again, now my concern is that it's a little climactic and getting further from the moving average than the moving average can keep up with it. It's unsustainable. You might get bulls taking profits, which leads to a sell vacuum, where bulls will look to buy below bars. As always, please feel free to leave questions in the comments and include timestamps for any question specific to this video. And again, I apologize for my voice in this video. And with that, hope everyone has a good rest of their night. Thanks for watching.